This is the final screencast in the Bob's Instant Coffee case. In it, we'll be looking at accumulated depreciation, interest expense, amortization of a note payable, and dividends payable. The balance sheet at the end of the last screencast is given here for reference. And the first transaction we're going to look at is depreciation. Remember, BICC purchased the instant coffee cart for $22,000, and now it's going to depreciate it over 72 months on a straight line basis. The first thing is to determine how much is the total amount of depreciation to be taken. This is a fairly easy calculation, as you start with the original cost, subtract off the expected net realizable value at the end of the useful life of the asset, and in this case, you see we have a depreciable amount of $22,000. Since we're using straight line depreciation, we take the $22,000, divide by the 72 months, and end up with a depreciation per period of $305.56. We recognize the depreciation expense as a debit to depreciation expense, which would go on the income summary, and a credit to the contra account called accumulated depreciation. Plant and equipment then is shown on a balance sheet as two separate accounts. The plant and equipment at cost, $22,000, and then the total amount of depreciation taken on the asset thus far, which is the credit balance and the accumulated depreciation. So if plant and equipment is shown as a single line on a balance sheet, it would be the net amount of plant and equipment, $21,694, that is presented. And once again, we can look at the before and after balance sheets and see once again how the journal entry for depreciation expense impacts the balance sheets. Difficult transaction is the amortization of the note payable. As you remember, each month, BICC must make a payment of $500. Well, the payment is easy to record. It's a reduction in cash of $500. The more difficult part is to recognize how much of the $500 is interest expense and how much of the $500 is a reduction in note payable. This is called amortization. Well, one way of calculating this is to set up an amortization table, and I've done that for the first 5 months of payments. On this slide, I've put all the calculations and labeled each of the columns. So remember, what we want to do is figure out how much is interest expense and how much is amortization of the note payable. Well, interest expense is not too hard to calculate. It's the balance of the note payable for the month times the interest rate, column 2 times column 3, and we multiply those together, we get column 4. And so the interest expense for the month is $117.92. Remember, since it's an expense, it will be a debit to the income summary account. Now, amortization is also not too hard once we know interest expense, since we have the payment, $500 from column 5, minus the interest expense, $117.92, so the remainder is amortization. Next, we can look at the opening balance in the following month, and this, once again, is not too difficult to determine. We just take the opening balance in the current month, subtract off the amortization in the current month, and that gives us the opening balance in the second month. We can then calculate the interest expense and amortization in the second month, just as we did the first, starting by taking column 2 times column 3 to get interest expense, and then taking column 5 minus column 4 to get the amortization of the note payable. Remember, the amortization of the note payable being a debit will reduce the liability, notes payable. So on the balance sheet, we can see that notes payable goes from an opening balance of $15,723 to a closing balance of $15,341. We've now worked through all of the accounts that pertain to the Bob's Instant Coffee case, and we can prepare an income summary. And if we do, we'll see that the net income for the period is $356. To close the income summary account, we need a debit to the income summary, since the income summary has a credit balance before closing. And the credit here then goes to retained earnings. So remember, this journal entry transfers the balance from the income summary to the retained earnings account. We have one final transaction to account for, and that's the payment of dividends. It's important to remember that dividends are not paid out of income, but are paid out of retained earnings. And that's why the dividends payable is calculated after we've closed the income summary account. In this case, 60% of net income for the period are going to be paid out as dividends. Since the payment is not yet made at the end of the period, but made in the following period, rather than crediting cash, we have a credit to dividends payable. So we take the income for the period, $356, multiply it by 60%, then that's the amount of the dividends payable. And remember, dividends payable is a liability. The debit here is $214 to retained earnings, so this will reduce the balance in the retained earnings account. And if we look at a retained earnings T account for the period, we see the beginning balance, $2,405, income, $356, dividends declared, $214, and therefore an ending balance in retained earnings of $2,547. This retained earnings T account is very useful when the accountant goes to prepare the statement of retained earnings, another one of the required GAAP financial statements. We can take a look at the closing balance sheet for the period. Notice dividends payable listed as a liability, and also notice the final balance in the retained earnings account. So this completes our BICC videos. This is the third of 3 videos. As always, we've included a few extra questions that we recommend you do just to check your understanding.